Okay, so yeah, so thanks again for coming. Today, Melinda Crows will be presenting on credit as an asset. Um, if you have questions, sort of clarifying questions as we go through, if you can put them in the chat box and have a queue, sort of, put a queue in front of your question so we know that that's a specific question that you have. Melinda's going to have a few things that we're actually going to be using the chat for other things, so it'll just be helpful so we can, see the difference between questions and the tasks that Melinda will have us doing. Yeah, you're definitely welcome to also, if for some reason I'm not seeing that, if you want to unmute yourself and kind of just say, hey, one quick question, but hopefully everything goes well. And I think that's about it. Anything else, Melinda, that you'd like everyone to know?
I don't think so. I think we can go ahead and get started.
Okay, well, great. I'll hand it over to you.
Okay, awesome. Thanks. And thanks everybody for joining us tonight. I know it can be a bit of a struggle to turn the computer back on at the end of a workday and spend a little bit more time learning when we're all tired. So I'm going to try to make this as fun as possible, as I know how to in the virtual environment. So the presentation that I'm going to do tonight is actually something that I'm doing with my work with Credit Builders Alliance. And we are doing this as a pilot for my work, but also because we know that it's such an important topic that a lot of people are interested in. So I am going to ask folks if you're willing to do a survey at the end. And because I am doing this for my job and that it is part of a pilot, I won't be able to share this particular slide deck. However, I have a very similar slide deck with the same content essentially in it that I am able to share. So I'd be happy to provide that to anyone who's interested at the end of the session. So as Dylan mentioned, we are going to be doing question and answer at the end of each section, but you can certainly feel free to put your questions in the chat box beforehand and just stick that cue in front of your questions. That will help us keep it straight. And if you have a question that you would like to ask verbally, you can feel free to raise your hand or unmute yourself. A quick tip for unmuting is that you can just hold down the space bar and talk, and that will unmute you temporarily. So that makes it just a little bit easier. Our agenda for tonight is credit and your goals. Then we're going to play some credit Jeopardy. I'll do an overview of credit reports and scores, some credit and budgeting considerations during COVID-19, and then a bit of information on debt repayment. So in the chat box, if you have access to that, if you want to just quickly write in what words come to mind when you think about credit. So what is your gut feeling? What words are coming to mind as you think about credit? So we've got one person who's saying debt. That is often the first thing that people say. It's credit and debt are closely linked, but they don't have to be. And part of this presentation, we'll be talking about how we can build credit without getting into debt. Hassle, that is like an excellent word as well. Credit is complicated. I can easily do a 2-day training on credit. And there's a lot to know. It can certainly be a bit of a hassle. Any other words that are coming to mind? Some people have positive associations with credit. Often when I do trainings on this topic, some people will be like, oh my gosh, it gives me so much freedom. It gives me so much access to the things that you want and more importantly need. That there's some security in having credit. So some of those are words that we often hear as well when we think about credit. So let's frame the conversation by taking a look at the word credit. And perceptions of credit can, of course, be positive and negative. The word credit comes from the Latin cred or credit, which means trust, value, and worth. The word debt refers to what is owed to others. While the two are not synonymous, for many of us, using too much credit may lead to crushing debt. And I mean, it's not hard to see that association. But credit can be a tool. And with all tools, proper knowledge and management is key to success. At its core, credit allows you to buy something now and pay for it later. Debt, on the other hand, is a liability. Credit building is a critical strategy for achieving a good credit profile. While credit building is not about acquiring debt, it does require using credit. And our system relies on credit reports and or scores, or the lack thereof, to determine whether individuals or small businesses can access a whole host of products and other opportunities, and at what cost. Though they are often lumped together, there are these essential tools that help a client understand their credit profile. As we noted, the credit report presents a summary of consumers' credit history at a moment in time. It may be helpful to think of the credit report like a report card that is a summary of your activities. A credit score, on the other hand, is a risk model that is commonly used by lenders and other types of businesses in order to assess the level of risk that they take when offering a consumer a particular loan or other product or service. It may be helpful to think of the credit score as comparable to a GPA. It's a number that has an association with it. Both the credit report and the score are important to understand, and both can be used as key financial education tools and part of our financial journeys. Now on the screen, I have a diagram, and I'll go through each part of the diagram here. And this is helpful in understanding how credit building works. So while there are many different pieces of information that can appear on a consumer credit report, the account status is a crucial component in how different types of accounts can impact the credit score. This chart shows how we can think about account statuses in 4 different categories. So the x-axis illustrates whether the accounts are open or closed to new activity, while the y-axis describes how these accounts may impact the credit score negatively or positively. So we're going to start in the upper left quadrant in the gray square. And in this quadrant, we have accounts that are closed to new activity but have been paid as agreed. So that might be like an auto loan that you paid off in full. You didn't miss any payments on it, so it was closed in good standing. So that is a positive. While these accounts ultimately do have a positive impact on the score, there's a diminishing return as these accounts age, and that basically means that they lose their impact as they fall off your credit report and as they are no longer an active account. Now in the bottom left quadrant, which is kind of that beigey color, we have accounts that are closed with a derogatory status, and that would be something like a charged off card or a collection account or public records, which would be something like a bankruptcy or a tax lien or even an eviction. And these are derogatory accounts by definition. And while consumers may still be paying off these debts, they are closed to new activity, and therefore they are no longer avenues for access to credit. And accounts in this category can only have a negative impact on the credit score. So really what that means is once an account goes into this negative status of collections or public records, they can no longer help to build your credit score in a positive way. Oops, oh, sorry, I keep clicking a little too soon. On the bottom right, so that's that lighter yellow, we have the open credit accounts that may have some negative information. For example, a credit card that is currently 30 days past due. And while the negative activity would bring the credit score down, these accounts are still open to new activity, and therefore a consumer could resolve the delinquency and continue to use the account. So maybe you missed a payment on a credit card and went 30 or 60 days past due, but the account is still open. So that has the potential to increase and build your credit score if you get that back on track and pay it on time. And then finally, we have the upper right quadrant, which reflects open accounts that have a positive payment status. And this is really where the credit building happens. So accounts that are open, current, and have recent activity are considered active and thus have the most potential for positively impacting the credit score. It's also worth mentioning that accounts in the bottom right quadrant may have the potential to become active, helping a consumer build credit if they are able to resume regular on-time payments on the account. the negative history and its impact on the credit score will diminish as time goes by. So hopefully this chart helps to clarify some things. Again, we really want to focus on that active credit, and I'll explain more as we go about how to do that. So I really just wanted to give you these credit building fundamentals at the very beginning. Good credit will happen if you open and use at least one credit product, a credit card, a loan, etc. In order to see an increase in this credit score, you have to have at least one credit product open and in use. If you do not have a credit product that is open and actively being used, your credit score will not be able to increase. This can be as simple as having a credit card with a reoccurring purchase on it each month. So that could be something like your Netflix account or Spotify or something along those lines, or maybe maybe it's a card that you use every month when you get gas or pay for your public transit, and then you pay it off on time. It takes 6 months to generate a FICO score, but you can have a VantageScore in less time, like 2 or 3 months. If you are starting out without a score, you will likely be scored in the mid 600s after 6 months. But note that we can't predict exactly what anyone's credit score will be, as it's dependent on your usage. Now, point 2 is, if you have a credit card, stay below 30% of the limit on each of your cards. So for example, if you have a credit limit of $1,000, do not spend over $300 on that card. So 30% is a rule of thumb, but the people with the very best credit scores have a utilization rate of under 7%. So in the case of a $1,000 credit card limit, that person would be spending less than $70 on that card each month and making sure that that's paid off on time. And then third, pay your creditors on time each month, or at least within 30 days of the due date. So this is really important. Like, payment history is the most important part. Credit is reported as late if it's not paid within 30 days of the due date. So make sure you're at least paying on time within that 30-day period. So good credit equals access to high quality financial products. Many of us require these credit products to weather economic shocks, such as unexpected job losses, cars that break down, or sometimes just a smooth income and expenses that fluctuate through the month. Without access to credit, many must depend on predatory lenders and higher interest rates, and they may fall into a cycle of over-indebtedness. Having good credit can actually help us to avoid debt. Having good credit makes it easier for us to find affordable financial products at lower interest rates, and it makes it easier to pay it off faster. Good credit equates to opportunity and options for things like housing, as many landlords pull credit reports to determine whether to rent to an applicant, and sometimes how much of a security deposit to charge. Good credit scores will save consumers money, which can come from reduced interest rates and fees, as well as reduced or eliminated costly deposits. A positive credit rating may also reduce the cost of products such as car and homeowners insurance. Building credit is one step towards the larger goal of financial stability, and allows us to save, improve our financial stability, and ultimately lead to financial security. According to the Federal Reserve, almost 40% of Americans wouldn't be able to cover a $400 emergency with cash savings that they could quickly pay off, and about 60% of Americans do not have $1,000 in savings or cash available to them. This statistic really hit home recently, and is easy to see with the coronavirus. This can lead to difficult and stressful situations, and possibly lead to reliance on much higher cost lending if we find ourselves dealing with an unexpected expense or emergency. Some people have the income, savings, and assets, or at least family or social safety net, to fall back on to weather financial challenges, but many do not. The truth is that we live in a two-tiered financial system in which having no, thin, or poor credit is a barrier at best to achieving and maintaining financial stability, and at worst to ensuring that we don't become trapped in unsustainable cycle of debt and financial turmoil. Since most of us require access to small dollar credit, like a credit card, to weather these economic shocks, or even an unexpected but often not well planned for expense at some point in our lives, those without access to reasonably priced and potentially even free credit may have to turn to payday and other high cost loans to get by. Compare this to using a no-fee credit card to manage cash flow and paying in full at the end of the month, which effectively makes it a 30-day interest-free loan. Those of us who may not be able to pay off our monthly credit card balances may wish that we could, but at a minimum, we recognize that the cost benefit of owning and using our cards means that we do have a tool to maintain certain expenses or to use as a lifeline in the case of an emergency. Credit information also plays a greater role in the determination of car insurance premiums than driving history. On average, drivers with good credit scores pay $214 more per year for car insurance than those with the best scores. In some states, drivers with poor credit can pay as much as $2,000 more per year than drivers with excellent credit score. And people with no credit pay 65% more for car insurance than people with excellent credit on average. Utilities and cell phones are also impacted by credit. Individuals who do not have a credit score or a low score may be required to pay a security deposit for these services. Good credit leads to reduced expenses or costs and can save a person thousands of dollars over their lifetime. Increasing one's credit score can therefore serve as a sustainable and systematic strategy for saving money. Good credit simply yields better loan rates. In this example, what is the potential monthly savings for having good credit compared to poor credit? It's actually $62 per month, but we can see that this person with good credit will save over $3,718 over the life of the loan by having good credit, which is really significant. There's a lot I could do with almost $4,000. Now, in this next example, we have an example of a $250,000 mortgage with a 30-year fixed interest rate. So what is the potential savings, monthly and total savings for having excellent credit compared to fair credit in this example? It is $238 monthly and almost $86,000 over the life of the loan. And this is based on credit score alone in this example. And honestly, with mortgage rates being quite low right now, the savings could be even greater. So we really know that good credit can help us save so much money for the exact same house or for the exact same car. As we talked about, we all have different approaches to how we think about credit. We want to shift the paradigm from thinking about credit as a deficit to thinking about credit as an asset. Credit and debt are not the same. In fact, good credit, along with strong budgeting and saving skills, can help us to avoid debt. We can also build credit without going into debt and, in fact, receive incentives for using credit, such as cashback, airline points, discounts, etc. There is always something that you can do to improve your credit, even if your credit is poor right now. Your credit is not ruined forever, and you can make choices to improve it, and I'll talk about some of that here today. So, we've shared a few examples of the cost of credit, but how much does credit actually cost over a lifetime? Does anyone want to take a guess? If you do, you can feel free to put it in the chat. How much is the cost of poor credit compared to the cost of good credit over a lifetime? So researchers found that when comparing people with poor credit to those with excellent credit, I'm not seeing any chats come in. Oh, we've got 1 million, not quite that much. The lifetime cost of credit alone can be over $200,000. It could very well be quite a bit more than that. I wouldn't be surprised if some people are up there in that 1 million range. And this is really why we place so much emphasis on building a good credit score, because this is a really significant savings that we want everyone to have access to. So, Sergio, I like your answer. $200,001. So setting SMART goals. Let's take us a few minutes to think about our financial goals, and hopefully you can spend some time in the next few days or next few hours jotting down some of your financial goals that are short and long term and that you're trying to achieve. So one way to think about this is through the SMART goals framework: specific, measurable, actionable, realistic, and time-based is one way to do that. So we know that credit building is never for the sake of credit building alone. Having a good credit score doesn't mean much unless you can actually use it. Some people like to get a little competitive with their spouse or their partner, and have a monthly rivalry to see whose credit score increases the most. And that's good and fine. And if that's what helps you motivate you to improve your credit, then great. But really, what we want to focus on is what you can do with your credit once you have a better credit score. So for example, one person I talked to recently was denied an apartment because of her credit being low. She found another apartment but had to pay 2 times the security deposit because of her low credit. Another person that I talked to would really like to refinance a car loan that's like 26% interest. It's quite high, and credit building could help her do that once her credit score gets up a fair bit higher. So those are some of the examples of how credit building can help you achieve your goals. Okay, now we're going to play a quick game, and I'm going to pull up the poll feature, and I'll give you a little bit of time to answer these polls. Launch poll. Okay. Can you see the poll on the screen? If you can start answering these questions. Okay, you can see them. Great, thank you. Okay, so I'll read them off. Go ahead and answer them. If you pay all your monthly bills on time, you will have a high credit score. And these first ones are all myth and fact. Question 2, if you only have collection accounts on your credit report, you may not have a score. You can ruin your credit by applying for a few new lines of credit, otherwise known as making inquiries. Lost my mouse there for a second. It is possible to go from unscored to a prime score in 6 months if you have 1 reported loan you pay on time each month. A single delinquency can reduce a credit score by as much as 100 points. And then the last question is, how many credit scores can one individual have? So I'm not seeing any votes come in. Are you able to, okay, there we go. Maybe it was just a little delayed. Okay. Give you another 10 seconds or so, maybe a little more than that. There's quite a few questions here. Okay, it looks like 6 people have voted. Okay, I'm going to go ahead and end the polling, and then let's go through each of these. I'll put this to the side here. Okay. So if you pay all your monthly bills on time, you will have a high credit score. The correct answer to that is myth, which 67% of folks got correct. So paying regular bills on time is great, but this won't build credit unless the payments are reported to 1 or more of the 3 credit bureaus. And we're going to go through all of these in detail, and I'll explain more about this as we go through the training. If you only have collections account on your credit report, you may not have a score. And the answer to that is fact. And we've got, well, everyone got that wrong. That's okay. We're going to go through that. So in order to have a credit score, consumers must have active trade lines. Collection accounts can never be active. So number 3, you can ruin your credit by applying for a few new lines of credit, otherwise known as making inquiries. The answer to that is myth. Applying for new credit does affect the credit score, but only by approximately 10%, so a very small amount. And then next, We have, it is possible to go from unscored to a prime score in 6 months if you have one reported loan you pay on time each month. And the answer there is fact, which yes, we got 83% correct on that one. And then finally, a single delinquency, a single late payment can reduce a credit score by as much as 100 points. The answer there is fact. And it looks like we had 83% got that one right as well. So great job, everyone. And then, let me get this. There we go. Okay, and then for our question on how many credit scores can one individual have? And the correct answer is actually too many to count. And we only had 2 people get that one right. So we'll go through that again as well. That's a very common misconception. A lot of folks think that there's only the 3, one from Experian, Equifax, and TransUnion, but that's not actually the case. Now I have a few more Jeopardy questions for you that you'll have to respond to in the chat box. So get your typing fingers ready. And yes, great job, Stephanie. Okay, so what are the 5 principal factors that influence a credit score? See if you can name as many as you can in the chat box. Late payments, kind of. Bankruptcy, we've got percent of credit used. Great. That one is correct. Okay, I'll go through these. Loans we've got. So our 5 principal factors that influence a credit score are payment history, amount owed, which is known as the utilization rate, length of credit history, new credit, and credit mix. And I'll go through each of those momentarily. And then finally, which factor has the strongest influence on your credit score? You want to type that in the chat? Which factor has the strongest influence on your credit score? And Jennifer, Dr. Flowers got it right. On time payments. Payment history is absolutely the most important thing you can do to build a strong credit history. Great job. Okay, so now let's go into the 3 major credit bureaus. So Equifax, Experian, and TransUnion are the 3 major credit bureaus, and each of them customizes reports for various consumers and business purposes. There are many other specialty bureaus that are used for different purposes like insurance, auto lending, apartment rentals, employment, and credit checks, and all of that. The credit report is, again, the summary of our credit data, and the credit score is a risk model that's used to determine how likely you are to pay on time or how likely you are to default. A person with a lower score is seen as a higher risk than someone with a higher score. It's a point in time measure, and it certainly does not mean that that's going to be your score forever. Like your score can absolutely improve over time. Let's go through what is not on the credit report. So first we have beliefs and affiliations. So like your gender, ethnicity, religion, political affiliation is not on your credit report. Non-credit banking information such as checking and savings account, that is not on the credit report. Non-delinquent accounts such as your utilities, those are never going to be on your report unless they're in collections. The same with your phone bills. And then old accounts that no longer report per the Fair Credit Reporting Act. So after 7 years, most things come off your credit report. There are some exceptions to that, but 7 years is the rule of thumb for how long accounts are in your credit report. So as we dive into the main sections of a credit report, we want to know that the information we're providing is general, and that the credit reports that you are looking at may differ in how they look and in their coding. The different sections of the credit report are personal identifying information, credit history, public records, and inquiries. So name, birth date, social security number, current and previous addresses, and employers are part of the personal identifying information. Some of this information only gets updated when you apply for credit, so it's not unusual for some of this information to be out of date. It is very important to review this section for unfamiliar information, which could just be a sign of just an error, just a typo, but it could also be much more serious if it is identity theft. Make sure that whenever you are applying for credit, you're using your full legal name. Don't use nicknames. So my name is Melinda. I never go by Mel, but if I did, I would never write Mel Crows on an application for credit. I would write my full name, Melinda Crows. If you're a junior or a senior or first, second, third, you would want to include that on the credit application as well. If you are an ITIN holder, do not use your ITIN in place of a social security number on the credit application. The next section of the credit report is the credit history, and this includes the types of accounts, the payments, outstanding balances, credit limits, date accounts, opened and closed, and current status, such as on-time or late payment. So this is where you're going to see your student loans, your auto loans, any credit cards you have, or personal loans. That's all going to be on this section. Then we have public records. So the public records section includes bankruptcy filings. Chapter 13 bankruptcy can remain on the credit report for 7 years, and 7 years and 180 days to be specific, from the filing date, while the Chapter 7 can remain on the credit report from 10 years from the filing date. So just a note that public records are more limited now than they used to be due to changes in the law in 2018. So your civil judgments and tax liens are no longer going to be on the credit report. That doesn't mean that you don't owe them. You still do owe them, but you might have to look elsewhere to find those. And some of the other places that you can look are a credit reporting database called LexisNexis, or else you can look at your local public records. And then the last section of the credit report is inquiries. And this is where we'll find the folks who have looked at your credit. That could be lenders, employers, and others who have requested your report in the last 2 years. They fall into 2 categories: soft inquiries and hard inquiries. So soft inquiries, which we sometimes call soft hits, are initiated by consumers and some businesses for educational and informational purposes, whereas a hard inquiry is initiated when a consumer applies for credit. So if I go down to the Target and I put in an application for credit to get that 20% off, that is a hard inquiry, and I wouldn't recommend doing that, by the way, and that will impact my credit. If I look at a site like Credit Karma to just see what my credit score is, that is a soft inquiry. The soft inquiries do not impact the credit score, but they are going to be on the consumer disclosure reports only for 24 months, whereas the hard inquiries are going to be on the report for 24 months, but they only impact the score for the previous 12 months. So even though they're on the report, they're only impacting the score for 12 months. And again, that is a fairly minimal impact on the score, but you still want to be prudent about when and how you're applying for credit and make sure that it's aligned with your credit building goals. So remember that you have the right to receive 1 free copy of your credit report from each consumer reporting agency each year, to be informed if you're denied for a loan or receive unfavorable terms because of negative information on your credit report. You can dispute information that you believe to be incorrect, and you can receive a free copy of your credit report if you dispute something successfully. Because of the data breach with Equifax, you can actually now receive your Equifax report 6 times per year through December of 2026. So if you want to keep up on your credit a little bit more, go ahead and get that Equifax report up to 6 times a year. So with this, consumer access to credit reports, the place to go to get your official credit report is annualcreditreport.com. We would recommend getting this, if you haven't seen your reports recently, to get them all at once and then to stagger them every 4 months or so after that. One of the tips that I often give that people seem to really remember is to get one like on the Martin Luther King Day weekend, get one on Memorial Day weekend, and then get one on the Labor Day weekend. And that will help you keep up with your credit over time so that you're looking at your report every 4 months or so. And each of these reports is going to contain different information, as different creditors may report to all 3 of them, or they may report to only one of them. You can also get a copy of your credit report when you are denied for credit, or if you're denied for favorable terms, and then you'll get an adverse action notice, and that will give you access to the report that the lender used when they denied you for credit. You can also get free access to credit if you go through like a nonprofit coaching or counseling program. In order to access your credit report, you're going to be asked to input personal information, such as your addresses, your date of birth. You're going to then need to answer some security questions. Sometimes people have a hard time with this. It might be like, what county did you live in 2015? You may have an auto loan that was opened in March 2018. Who's the lender for this loan, or what's the approximate monthly payment? And then if you're able to confirm your identity, you'll be able to download and print that report. If you're not able to, you can mail in a form along with copies of your identification, and then they'll be able to send you a credit report through the mail. Now, given that so many people are experiencing really significant financial issues due to COVID-19 and loss of income or a reduction in income, and their finances and their credit are being impacted as a result of that, we'd really recommend getting a copy of your credit report now so that you can show that you had show what the payment history was prior to the economic crisis that we're currently in, and then after, like, so showing that you were a good payer prior to losing your job or income source. So what about those free credit score platforms? So this is sites like Credit Karma, Credit Sesame, as well as a number of others. You might see them through your bank or credit union. And when we're accessing these free credit scores in particular, there's a number of considerations to keep in mind. And there's some great benefits to it, such as summarized credit information, some personal recommendations to improve your credit score. These are certainly attractive features. But if someone is in need of detailed credit report information or lacks a social security number or is challenged by the security questions asked, then this might not be the best place to go. And while this is marketed as free, you are giving up a lot of personal data in order to get this information. Another consideration is that the free credit score platforms like Credit Karma and Credit Sesame, they use a VantageScore, whereas most lenders for auto loans and mortgages in particular are going to be using FICO scores, and the scores can be fairly different between these. And I'll talk more about that momentarily. You'll also receive a lot of marketing messages through that, so that is another consideration. So I'll pause here to see if we have any questions so far before I go into the credit scores section. So any questions, you can feel free to unmute yourself or type a question in the chat. Okay, I'm not seeing any, so I'll go on to credit scores. Okay, while there are many different credit scores, with the most common scoring range being between 300 and 850, we're going to talk in more general terms about what it means to have good credit. So generally, higher credit scores indicate to lenders and businesses that people are going to be a better customer, and that means that they get paid. And people with the highest credit scores will get the best rates and the terms on loans and other products, whereas those with lower scores may have to pay more for their loans and services or may be denied completely altogether. So FICO reports that as of September 2019, the average national credit score reached 706 for the first time, which is definitely in that good to excellent range. So that is very promising. I think that we can expect to see that go down because of the current economic crisis. So note that if you have not used credit at all or credit recently, it's possible that you will not have a credit score. But regardless of where you're starting from, it's important to focus on moving that credit score, that credit trend upwards. So why might someone not have a credit score? There's a few reasons, including that they've just never used credit cards or loans before. Maybe they've used cash for everything. Maybe they're a young person, an 18-year-old just starting out, and that hasn't been something that they've needed or had access to. They may have only used credit in the past, but they don't have any accounts with recent activity. Sometimes if you have like a credit card and you're like, oh, I'm only going to use this for emergencies, because you don't have any activity on that card, that's not generating any activity, so therefore you're not going to have a score. So great that you have the card, but it won't actually help you build credit unless it's used. So if you don't have a score, the good news is there's nowhere to go but up. The bad news is that lenders might treat you as a high risk and either deny you for credit products or give you much higher interest rates. So lenders use different scores to measure risk for each of their unique lending purposes. Basically, lenders might be looking for distinct and different characteristics in borrowers applying for different types of loans. So someone who is applying for a credit card, the credit card lender is looking for something different than an auto lender or an insurance provider. Credit score developers have developed a variety of calculations and algorithms and different scores to meet lenders' underwriting needs. And as we learned in Credit Jeopardy, there are hundreds of different scores available. I looked at 3 different scores of mine personally in the last week, and they all varied by 20 points from the lowest to the highest. So that is a very common thing that you'll see if you look at more than one credit scores. So when people ask you, what's your credit score? Really, the correct answer is which one, because you have so many of them. While there are many different scores and different companies that generate them, including the major credit bureaus themselves, we're going to focus on the 2 types of scores that you may have heard of, FICO scores and Vantage scores. So FICO creates the most widely used credit scores in the lending industry. Mortgage lenders in particular use FICO scores almost exclusively for their underwriting purposes. So if you're going to get a mortgage, they're going to use a FICO 4 score. VantageScore Solutions was created jointly by 3 major credit bureaus in 2006 in order to design a consumer-friendly and at the time a more accessible credit score. Let's focus now on the key factors of the credit score and the underlying actions you can take to impact them. FICO and Vantage each have different methods of calculating their scores, but there are many similarities in what types of actions are most important. Namely, that payment history that we talked about in Credit Jeopardy is the #1 most important factor for FICO. Paying your creditors on time is so important. And we know that that's not always possible, but if you can pay in at least that 30 days after the due date, you're in a much better position in terms of your credit score than paying even on the 30th day late or the 31st day late. Similarly, Vantage Scores also prioritizes payment history most heavily, but it also looks at the age and type of credit, the percentage of available credit used, total balances in debt, available credit, and recent credit behavior and inquiries. As we look in this next section at scoring factors more closely, we'll start with payment history. And payment history is that single most important factor. In order to have a payment history, you have to have at least 1 active installment or revolving trade line. A strong credit profile can be categorized by having on-time payments, no serious delinquencies, and demonstrating consistent usage of existing credit accounts. So make sure that you have your credit account set up to auto pay, or that you're making sure that you're paying them at least by the due dates in order to avoid that delinquency. What are the implications of non-payment? Well, it's really quite serious. If you note here that being 30 days or more late on even 1 payment can reduce your credit score by as much as 100 points. Also note that if you have a higher score to begin with, your score drop will actually be more significant, as it's more of a surprise that you are missing a payment. So you could like pretty quickly drop from a score in the excellent range to a score in the, just good or even the fair range by missing one, if not two payments. So this is why we really emphasize making sure that those payments are made on time. And that remains the same even in the midst of this economic crisis that we're in. If you miss a payment, you are going to see a really significant credit score drop. And I'll talk in a bit about some of the workarounds to that. With our next scoring factor, outstanding debt, this is also called the utilization rate. We want to note that with a revolving account, the consumer decides how much to pay each month on their revolving debt. And there are some helpful rules of thumb, such as maintaining that balance under 30% at all time. And the ideal is to maintain as low of a usage as possible at all times of the month and not to max out any one card or any one account. Note that people with the very best credit scores have that utilization rate of 7% or lower. A strong credit profile may be categorized by paying off balances and maintaining very low balances across all revolving accounts. So just to break that down a little bit further, if you have 5 different credit cards, look at the outstanding debt on each of those, as well as the credit limit, and make sure that you're below the 30% utilization on each of those, as well as an average, in order to maximize your credit score. There's nothing magical that happens when you reach that 30%, but we just know statistically that that's when you start to see a higher credit score increase. Okay, we're going to consider an example here. So we have Ruby. Ruby has her 3 different credit cards open. On the first in green, she has a limit of 1,000 and owes 500. On the second in orange, she has a limit of 2,500 and she owes 1,500 on the last, which is in blue. So she has a limit of 2,500, but this card is completely paid off. What is her utilization rate on all of her cards? She has 6,000 in credit available to her, and she's using 2,000 of this credit. That makes her utilization rate 30% right now. Okay, so let's say she goes ahead and decides to close the card that she is not using. How does this impact her utilization rate? She now only has 3,500 in credit available to her. She's using 2,000 of that credit for a utilization rate of now 57%. So how would that impact her credit score? So from this example, it would negatively impact her credit score. But we would also want to note that maybe she has other goals in mind. Maybe she doesn't want this card for a particular reason. She may have some really good valid reasons for closing this card, like high annual fees, high interest rates, a tendency to overspend, etc. But in this example, we're just wanting to point out that closing accounts can have a pretty significant negative impact on the credit score itself. So just be cautious before closing any particular credit cards. Next, we'll move on to the length of credit history. And having a longer credit history is better, but that's something that's going to take time and it will come. With credit building, like any relationship, it takes time to form that trust. So if you're just starting out with a new credit profile, they don't really have anything to base your score on because you haven't been with them long enough. But after a few months, after a few years, they will be able to see your payment history and how you manage your account. Some of the factors that make up the calculation of length of credit history include oldest account and average age of all open accounts. So you'll see that when you check out your credit report. And we have more control of revolving accounts than we do installment, as revolving can maintain history forever, whereas installments only remain open for a fixed length of time. For an example, an auto loan might be 48 months or 60 months, and then it will be closed after that period of time. And then next, we have inquiries, which are the applications for credit. And these are also known as hard inquiries, and they can impact the scores. They're going to have more of an impact for someone with a thin file, which is someone who has fewer than 3 open trade lines, than for someone with a thicker file. They have the biggest impact in the few months after after the inquiry is made, but is generally not substantial, often in the range of 10 to 20 points. The last scoring factor we'll consider is credit mix. Creditors want to see that individuals know how to use different types of credit over a long period of time. As we know, revolving and installment trade lines are structured distinctly, and creditors care how consumers manage an account that is most similar to the line that they are considering extending. So do not necessarily go out there and apply for different types of credit simply to diversify your credit mix, but be strategic and only apply for credit when it fits with your goals. And if you need to apply for new credit, perhaps consider applying for a different type of credit than that which you already have, particularly if you don't have a lot already on your credit report. So this happens all the time. I'm asked, how much is my score going to go up based on any one action? And really the best answer that anyone can give is, it depends. There's just really no one answer to this, as the factors are the algorithms that are going to differ between different bureaus. So you might see a 20-point increase on one credit report and a 10-point increase on another. It depends on how you're accessing your score, where and who is providing it, your starting credit profile and credit score, the other activity taking place in your credit report at the same time. So for example, someone may pay off a car loan, and in the same reporting period, they open up a new car loan. Both of these will impact the score, and we're unable to say exactly how many points one action increased or decreased the score. You just want to keep your focus on the trend upwards and the underlying actions, which will ultimately lead to an increased score. Our best practices for strong credit scores, we want to remember to establish and maintain a mix, ideally 3, and then build on that for more. Different types of active trade lines that are used regularly and paid on time. If you have one or more revolving credit products in that mix, focus on keeping balances as low as possible. And then credit building, it's just not going to happen overnight, but it can actually happen relatively quickly when you know the right rules and have the right tools. So you want at least 6 months of credit history and activity for that FICO score, which is what most lenders use. It will be less for the VantageScore, but you can see even from the VantageScore, the movement that your score, the direction, the trajectory that your score is going in, which can be really helpful to track. Is credit building right for you right now? So the information on your credit report can help you decide your best next steps for credit building. So I'd really encourage you to go ahead and take a look at that annualcreditreport.com, or even the credit summaries that you're going to get from Credit Karma, Credit Sesame, and other sites, and keep track of that, as it is even more important now in this era when we have so much economic uncertainty. So I would just make sure that you have a copy of your credit report downloaded or printed out that's fairly recent right now. I'd really encourage you to do that, and that can help you decide some of your next steps after you look through your credit report. And as you're looking through your credit report, you want to check out what's on there. What are those accounts in good standing that have recent history? Are there any accounts that can be brought current, or old accounts that can be reactivated? So maybe you have a credit card that's been sitting in your purse or in your dresser drawer for a while. Maybe you want to stick that to a payment of something that you get on a reoccurring basis, or and then just make sure that you're paying that off every month to generate activity on your credit report. And then also take a look at that delinquent debt and collections accounts, which could be paid down and eliminated. And then, of course, also the incorrect information that could be disputed. So I wanted to go through some credit protection considerations during COVID-19 as well, and highlight some more specific guidance on this particular topic, as we know that some folks now are focusing more on credit protection than on credit building. So with that, I wanted to bring into the conversation a little bit about spending and savings habits. So many people have experienced some shifts in their spendings and savings patterns as a result of COVID-19. so many people have had reductions in income due to loss of jobs or hours. Others may be spending less due to saving on commuting costs and other expenses. So I'd really encourage you to take a look at your spending and see if there's anything that you might want to shift. If you are aggressively trying to pay down debt, you might want to shift some of this money into savings in order to build a larger cushion for yourself. Financial experts generally recommend starting with a cushion of at least $1,000 in savings as a good first goal. And know that that can be a lot, but it's a good first step. And then building that up to 3 months of living expenses, then 6 months of living expenses. Another note is about health savings accounts. And these are accounts specifically designated if you have a high deductible healthcare plan. If you don't have enough money in this account to meet your deductible, this might be something you wish to prioritize right now. If you have some stimulus money left, that could be an option for you. And then regarding debt payment, as we discussed, the credit implications of missing a payment are harsh and they are long lasting. They're going to last you for 7 years. So we want to prioritize making at least your minimum payments in all your credit accounts and paying more than the minimum if at all possible. If you have any concerns about loss of income and haven't built up your savings yet, you may want to consider putting money aside into savings rather than aggressive debt pay down at this time. And those are just some considerations. You, of course, know your individual situation, but just some of the advice has shifted a little bit due to the economic crisis. And I'm seeing and reading more of a prioritization on savings than aggressive debt pay down at this time. So making sure that we have enough money in case there is a loss of job or another emergency that comes about. Now, with the COVID-19 crisis, and as it impacts ability to pay bills, we want to make sure that we're contacting those creditors ASAP. And that might involve being on the phone for a long time and trying to get in touch with them. But you do need to contact your creditors and let them know that you have experienced a loss of income as a result of COVID-19. There's special coding that lenders can use when there is either a natural or declared disaster. So right now we're in what's called a declared disaster. And it's important to pull and keep a copy of that credit report. As I've mentioned, you may also want to add a consumer statement to the credit report and note that the financial hardship occurred as a result of COVID and it has caused your credit to suffer. This statement has no impact on the credit score, and it just conveys information to lenders who are reviewing the report and could affect a decision to lend. And then you would want to make sure to update that when appropriate and take that off your credit report when needed. So with the CARES Act, there are a few considerations around credit payments and reporting that are important to understand. So how your creditor reports your accounts depends on the status of the account when the agreement or accommodation is made. So if your account is current and you make an agreement, whether to make a partial payment, skip a payment, or another arrangement, then the creditor is to report to the credit reporting companies that you are current on your loan or account. This only applies if you are already meeting the terms of the agreement and you want to make sure that you get any of these agreements in writing. If your account is already delinquent and an agreement is made, then your account will maintain that status for the duration of the agreement until the account is brought current again. So you'd have to catch up in order for your account to be indicated as paid as agreed on your credit report. And then lastly, if your account is already delinquent and an agreement is made, if you bring your account current, the creditor must report that you are current on your loan or account. And these terms only apply to agreements made between January 31st and the latter of 120 days after March 27th, which was the disaster declaration date. So ways that creditors may work with you, I'll go through these fairly quickly. So basically, creditors have options in how they work with you and if they work with you at all. And it is up to them. So that's why you're going to see some variation in the news and it's like, oh, well, this lender is doing this and this lender is doing this. So generally, how they're working with folks is going to fall into these three categories. So they may maintain the loan terms, but with flexibility. So they might extend due dates or offer grace periods. They might waive fees. And they do have an option for a special code that indicates that the account has been impacted by the crisis. That's going to happen behind the scenes. And that will just indicate on the credit report that you're experiencing an income disruption due to COVID-19 and the declared disaster. With forbearance and deferment, payments could potentially be postponed. You could potentially make interest-only payments, and payments could be shifted to the end of the loan term. And sometimes that can get a little bit tricky, and that can have some like pretty negative consequences as well. A balloon payment is basically when you have to pay the entire amount that was owed at the end of the term, and that can cause some pretty significant financial hardship if you do not have that money on hand. Or they could extend the term of the loan, so they'd add on like an extra 6 months to make it easier for you to pay at some point. And then loan modification, that is a new document would need to be signed, changing the structure or the terms of the loan. And it could potentially be a delinquent or a bad debt could be refinanced or restructured. Some lenders will do that, some won't. It may also depend on your credit score and your income situation, but it is potentially an option. And to make things a little bit more tricky, how payments are reported may affect various credit score models in different ways. So just something to pay attention to there as well. Just two more slides on mortgages and student loans. So mortgage considerations during COVID-19, if you can't pay your creditors, you would want to contact them, or I'm sorry, if you can't pay your mortgage, you want to contact your creditor ASAP and explain that you are impacted by COVID-19. If your mortgage is federally owned, which a huge number of mortgages are, you may be able to go into forbearance for 180 days initially, and then that's extended by another 180 days potentially. The interest continues to accrue, but you won't get late fees, and it's not delinquent for credit reporting purposes. So if your mortgage is not federally owned, your lender may also still have options that they can work with you on, but you have to call them in order to get that, or I shouldn't say call, you have to communicate with them in order to get that and make sure that you're getting that in writing. And then with student loans, so federal student loans, this has been all over the news, so hopefully you're aware of this. Payments are automatically suspended through September 30th, but you can make manual payments if you wish to. The interest is 0% through September 30th as well. If you are in the public service loan forgiveness, the months, even if you're not paying, are counted towards the required 120 payments for loan forgiveness. And then for private student loans, I'd highly recommend that if you're experiencing a hardship, that you would call and see if they have a hardship program. They may not. And with that, we'll go to questions here. I know we're at a little after 8:30 already. So that's fine. I'm happy to answer any questions. Let's see. And you can feel free to unmute yourself or type into the chat if you have any questions.
Melinda, I have a question.
Okay.
What sort of suggestions do you have for someone who perhaps they have, decent credit, they might have a couple credit cards, they're not really in a need to have any sort of loans, but to sort of build a credit score? What are kind of, things that someone can do without sort of taking out a car loan or a mortgage?
Right. Yeah, that's a good question. So if a person's like already pretty financially stable, has a decent credit score, maybe wants to improve their credit score a little bit more, some of the things that they could do are to just make sure that you're using that credit score, that what credit you have on a consistent basis. If you are not using it, the credit will go stale, and it will have less and less of an impact on your overall credit score and credit profile over time. So our recommendation is always to have something that you're using on each card that you have. Let's say you have like 3 or 4 credit cards, have something that you're using on each of them, like maybe every month, maybe every few months, in order to generate activity. So again, that could be something like, okay, I'm always going to use this particular card to get my groceries, and maybe that card gives you extra cashback points for those groceries. And maybe you have a different card that you use for travel, and that card gives you extra travel points for that as well. And then once you're using it, you're paying it off in full. So it's not about like going out and getting new accounts that you don't need, but being strategic and making sure that you're generating activity so that the score will grow as well, and that there's more for the algorithms to score you on. Does that make sense?
Yeah, thank you.
Great. Yes. Any other questions? Okay. I did have some more information on debt, but I know it's getting a little bit late already, so I'll just point you to some resources. If debt is something that you're dealing with and you're looking for some resources, these are some that I really like. Undebt It will show you a variety of different scenarios and ways to pay down your debt in the shortest amount of time possible, paying the least amount of interest. Vertex 42 is another really great website. It has some budgeting tools, some debt payoff tools, and it's all Excel spreadsheets with the formulas already set up for you. And it's a great resource to keep in mind. And then PowerPay, it's a little bit of a dated website, but it's very simple to use, and it's a great way to figure out debt payment options. And then let me quickly go through this. I have some additional resources on disputing errors and how you would want to go about doing that if you find that on a credit report. And then, let me keep going. So in summary, I had this slide at the beginning, but it's a great way to reiterate. Keeping it active. So again, keeping those accounts active, keeping your utilization low, and keeping it up so that you are generating activity. I am seeing a question that's come in on what's the credit range. So 300 is at the low end, 850 is at the high end. What's considered excellent or good is going to vary by the credit score model, but that 780 and up, you're going to get approved for anything. You're going to get really good loan rates, maybe like a 0% interest on a car loan, lots of cashback offers or travel rewards offers. And then when you're in that middle range, you're going to get approved for credit more than likely on your own, but you won't get a lot of those perks. You'll pay more on interest for sure. Once you get in the 600s, you're going to see that you might be required to have a cosigner. You might have to have a deposit in order to access credit that you need. And then if you're like roughly speaking below 600, you will often need again the cosigner, the higher interest rates, or you might be denied altogether. So if you're starting from a lower point, just focus on getting it up a little bit higher, getting it up to the next level, and then continuing to grow that over time. And I can really see that in the clients that I've worked with over the years, like you can really see a significant credit score increase in a fairly short period of time. Like 6 months is not that long. So, so definitely keep on working on improving your credit over time. So great question. Our upcoming webinar, so next week we have one on housing advocacy with Bill, and then Stephanie is going to share with us some spending and savings tips and some of her personal journey on May 4th. It looks like I have another question. So exciting. Any recommendations on credit cards to build credit? Yeah, that's a really good question. So I don't like to give recommendations of particular companies, but I do like a few resources that you can go to compare products. So I like NerdWallet is one of them. And then the other one is bankrate.com. And you can select your credit score range. So make sure you know your credit score range first. And then you can go to it and say, like, I am in the prime range. My credit score is about, let's say about 680. And then it will show you cards that you are likely to get approved for. So, and actually, I do have some slides on this. Let me just quickly go to this one. So if you're on the lower end of things, there's something called a secured credit card, and that will require you to, thank you, Dylan, that will require you to put down a deposit for that credit card. So basically you're securing it by your deposit, and then you'll get that deposit back after a few months of good usage. And you're generally going to have like a fairly low credit limit on that, usually around $200 or $300. And then after 6 months of good usage, you'll be able to graduate to an unsecured card. Another option is a credit builder loan. And you can often get those at credit unions. Again, I would reference bankrate.com and NerdWallet for those. And there's also a organization, a nonprofit lender that is in Chicago as of January, and it's called the Capital Good Fund, and they have some really great credit builder loan products, so I would take a look at those. They also have some resiliency loans or crisis loans for folks impacted by the economic crisis as well. They have some auto refinancing loans, and they do a manual underwriting, so you might have a little bit more luck with some of those products than you would elsewhere. Just to go through the authorized user, if you have someone in your life that has really great credit, they might be able to add you as an authorized user on your account, and that basically means that you can have access to their line of credit. It helps to build your credit, but you as the authorized user don't have any responsibility for that credit account. So you might have someone who is like a young person, an 18-year-old who, or actually you can even do younger than that, a 16-year-old who becomes an authorized user on their parents' account in order to help them build credit. So take a look at those resources, and hopefully that will help point you in the right direction. And then, let's see. Yes, other resources that I just always want to point out to folks. Center for Changing Lives in Chicago. It's in the Logan Square neighborhood, but they are doing services virtually, and they do financial and credit coaching services in English and Spanish. And I have Imelda's contact information up here on the screen. And then AFCPE, that stands for Association of Financial Counselors, or something along those lines. I don't quite know the acronym. But they are offering free financial coaching to anyone who wants it. So please do feel free to take a look at that for additional advice, as that can be a really, really great resource as well. And then if you guys wouldn't mind, I'm going to copy my survey in here. You could fill out the quick survey here that I just linked to in the chat. And I believe that will be it. We'll have this recording posted in the next few days on the River City website. And as always, you can feel free to reach out to me for questions or comments. And I'm happy to share a similar but different version of the slide deck with anyone who wants it. Just feel free to email me and let me know, and I can pass that along to you. And if there's not any other questions, I think we could call it for tonight. Thank you all for hanging in there and participation in this. And we'll hopefully see you next week.
Thank you so much, Melinda. for that.
Yeah.
I will stop the recording now. We can definitely, if there's any other questions,